Hey everyone, welcome to Smart Investing. Today's video is going to be the banking services sector, also known as the banks. So, five stocks that I have for you. First one up is ESXB, Community Bankers. As you can see, there is no volume, and for this stock, it's actually inactive. So, the last time this stock actually traded. Sorry, I was trying to move the screen. The last time this stock traded was in December of last year. So there is no activity. So I'm going to leave it blank and we're going to move on to the next one. Hold on, real quick. We just want to see. So it was actually a buyout, and that's actually what happened. Obviously, I don't know if they're a public company or private. As you can see here, United Bank closes a $303 million acquisition. So I don't know if they have a new ticker symbol. It doesn't say. But let me see. It's probably under UBSI. Uh, we can look at that if that is the new ticker symbol. So for UBSI, so $5.74 billion company, 2.63 for the earnings per share, slightly overvalued. I'm not crazy about the dividend amount. I mean, it's okay. It's just the earnings got to do better than that. 52-week high and low. Uh, could be better. It's actually gotten into new highs, so that is a difference for the new high of about $3. Uh, chart looks okay. It's been holding up, as we can see for the year. The high was in August, was about $40, and then started to break out in October. When October, the first 2 weeks of October, the first half of October, was actually pretty much a downside. And then the last 2 weeks, it started to be on an uptrend. I'm expecting another uptrend all the way towards Christmas and then January. Then January, I'm expecting the downtrend. And then in February and March, the next downtrend. Because earnings estimates should be lower. And if they're not, it's still bad news anyway. Because it just shows companies are slowing down, layoffs are more frequent, and once the dominoes get going from the mega cap companies, everybody else is to follow suit just to cut costs and also save money, I guess, trying to do more with less money. So anyhow, for the analysis for the quants, highest quant rating was Momentum at a 7.3. Overall rating is a 3 out of 5. I don't know if I'll agree with that. We'll look at the financials real quick. So, earnings estimates are actually getting higher. It's hard to believe, but yeah, I don't see that happening. Margins, it's not showing me anything. Their debt is at 84%, typically lower than most companies. Now, let's look at the annual. So the net income has been growing year over year. At least they have an average of about 10%. And then revenue, operating income is not showing me anything. Now we're going to look at the cash flow real quick. So are they positive or negative? So we have 609 with 15. So we're looking at 625. and they're definitely positive in cash flow. So they can definitely afford the dividend. And let's see what they're paying for dividend. 36 cents. They can definitely afford the raise. And for, let's see, around 2017. So 33 cents, then at 34 cents in 2018 and 19. They give a raise in 2020 for the 35 cents. And then for 2021, they continued most of that payment for 35 cents. And then the last payment in 2021 was a raise. So we'll see if the next payment is a raise. And most likely it will be. If not, then it'll stay flat for that year until they decide otherwise. So I guess this company, again, is slightly overvalued. It's a small market cap. The dividend, I'm not so crazy about it. To add it for a long-term portfolio, it's hard to say. They have a long way to go, obviously, with 52-week high and low. I'm going to say hold off on it. Just because it's slightly overvalued. And then income, I'm not too crazy about the income. They're better income stocks for a better related sector. And so the 52-week high and low, it just needs to be more than that. If it starts to break out to new highs, then might consider joining in real quick and then getting out. I'd say within a few weeks. This stock looks good for the short term, but for the long run, I just don't see it. So next stock up is CBU, Community Bank System. I want to see if you got the name right. So Community Bank System. So I did get the name right. Gonna look at the first page. Small cap company. Earnings are 3.29. Slightly overvalued. Somewhat active. Again, small market cap. 52-week high and low. That looks pretty good. I like those numbers. At least a $20 difference. It looks really good. Now, for the charting, let's look at the 5-year real quick. It looks like it's been holding up. Average price for the last 5 years. I don't see it breaking out anytime soon. The majority of this move was right here from March all the way to June. Downtrend. Got a quick pop up and then started to downtrend again. Now it's just breaking even. It's hard to say. I mean, let's see the shares. So it don't look like a lot of people are buying these shares. So 53 million. And then we have 53.73 million that was available. So the difference of these two is the amount that was acquired. So the difference for that would be, that wouldn't even be, let me see, that wouldn't even be not even 100,000 shares. It would be less than that. So that's the amount that has been acquired and doesn't look any more popular than it was now. So again, like I said before, as I said this in other videos, bank stocks typically are not momentum stocks. It's just the way the cycle is, even from quarter to quarter, year to year. Bank stocks are not typically known to break out as a sector. Yeah, every once in a while you might get one or two banks that break out, sell off for a little bit, but they take long to go up again. It's not like, it's not like they'll be hot in one quarter in the same year and then they'll be hot in the fourth quarter. Typically, banks are just not as popular. I mean, they're just there, like I said, they're just pretty much average Joes. So, gonna look at some history here, dividend history, and some financials. So again, I think the technicals failed, and we're just gonna continue with the fundamentals. Now, for this stock, ever since 2022, again, rising earnings. I don't know why they're not lowering estimates. I think that if for the companies that are not getting evaluated for lower earnings, those are the ones that are definitely, excuse me, those are the ones that are definitely going to struggle. Again, I don't know why they have not put companies that are not lowering their earnings. And I can understand if they did it from quarter to quarter, but for this whole year at an uptrend, I don't think so. That's just the dumbest move I've seen, to be honest. Now for, let's see, it's lagging. I'm not getting anything. So we're going to move on to the income. So 189, that was a gain. Let's see, compared to the last 5 years, second best gain. But have they gained from the highest one of the last 5 years? So yes, it did do better from the last time they gained the most from the last 5 years. So we'll look at that 168 to 189. That's a good number to grow from. Now, the balance sheet we have here 15.55 billion, and for debt 13.45, gives us a debt of 86%, 86.5% to be exact. Now, cash flow, and again, these are 2021 results, so that's what I'm going off of. I don't have anything for 2022 yet until the start of the year for 2023. Cash flow, we want to see what they have. So it looks like they are just positive. Hold on. Actually, it looks like they're negative 1.53. No, sorry. They're positive. Yeah, they're positive. So we're talking about 50, what? Around 50 million? That's the number. I'm trying to do the numbers in my head. So around 50 million in cash flow that they have left over. So dividends have been rising, not by much, only a penny. Percentages, I don't care. I just want to see if they have any flat payments that have not have any dividend raises. So again, these are low payments. I mean, 30 cents here, 30, I mean, a payment is a payment though. So 2020 paid 41 cents and they did not do a cut, and they continued to pay the 41 cents and then the raise in September for 42 cents. And then in 2021, they paid a penny higher from 42 cents to 43, and to 43 to 44. And for this stock, again, overall, to see momentum, forget about the income, because I just don't see this as an income stock. Now, let's look at the analysis real quick again. Highest rating was for quality. Overall rank was a 3 out of 5. Quality, I'm not certain. I can't really say. As for quality, each bank does their own thing. I know they have their own process for their loan and business models. But again, They seem to be doing pretty good, and they are in the northeastern area. That's what they look like. They're established for their services in business. But again, is there anything out of the ordinary that I'm reading that may benefit them from the competition? I don't see anything. If I want to dig deeper, I guess look at the actual site for this bank and see if they offer anything in particular. But I just don't see anything. So for this stock, I'm going to say, let me see, for the momentum, let me look at the chart again. So that is a difference of 60 to 65. What was the rating for momentum? Wow, said they gave it a rating of 2.76 for no momentum. So I'm actually gonna say no. And then for growth, I don't. Again, banks aren't really growth stocks. These aren't. See, the reason I don't consider banks growth stocks is because, yeah, they might acquire one another when they go bankrupt and whatever, but there hasn't been anything with like drastic change in banks for them to actually make more money and profit, to be honest. I mean, they'll make very few changes and minor changes, but it's not a drastic change where, oh, wow, uh, where we can see, wow, I want to invest in this company because they're a good bank. They're just not a popular investment. I mean, I'm not saying it's a bad investment. It's just not the best investment. That's all. They're just alternative sectors to that. I mean, you can't go wrong. They're stable. It's just that, again, they're just not as good as others, and they're just pretty stable. They're just pretty set and stable. And then in order for investments to do better, companies have to change and adapt and look for new ways to provide not only shareholders for their value and their time and their money, but also for the company as well. So sometimes it's a double-edged sword in the public markets because you got to benefit the company and then you got to benefit shareholders. And then other companies, they like to please both, and it's really not easy. So we're just going to move on to the next stock. So again, I said no for the last one, which was CBU. I said no to that one. So the next one I was looking at was CVBF. Right away, that chart just stood out to me. It looks like it's slightly overvalued. Again, I don't know a price. We will have to do the math if it drops a little bit, but definitely slightly volatile. You got many jumps here and there, but not too many big moves. Only big move I see is this one, and that was the start of July and ending around September. So for this stock, for income, I'm not too crazy about it. For day trading, it looks really good. Very, very temporary solution. Again, a stock for the short term. This one looks really good. It's hard to say yes for it long term, but yes for it short term, if that makes any sense. Just because the charting looks good, but again, the actual numbers, look okay. They're not as appealing as other stocks that I've seen before. So for this stock, again, almost a $4 billion company. PE is at 18. Dividend is at 0.8, so 80 cents. So you're looking at around 20, 40, 60, 80. Yeah, so 20 cents per quarter. Earnings per share is at 1.5. And for some reason, this stock has pretty good volume. Pretty good volume. As you can see, definitely on a uptrend. Even from the start of 2022, you can see that uptrend. So this stock definitely looks like a buy the dip strategy. I guess if it drops down $1 and sell it for $2 more. So for example, if it's at 28 and just with this obvious stock trend, I really like this for trading. Again, for the short term, not for long term. So if this stock is at 28, this is just me. Again, this is not a recommendation. This is just my perspective. It will look good at 27. Be nice to sell it at 29. Again, it's not much, but you're highly likely to get those amounts just because of the way this charting is. So we have here around 27, and then I have about almost reaching 29. So with this uptrend, I wouldn't get too greedy about it. But again, patience is definitely an asset to do with this stock. I'm trying to see the low. So that was a low in September of 24. So even at 25, it dipped down. So definitely a nice little move. You can get away with $1 and then see if it can go 50 cents lower than this price. So maybe at 27.5. And then, sorry, wrote the wrong number. Maybe at 27.5. And then for a gain of about 29 or close to it. Anyhow, see this 5-year trend started to go down, then jumped up, then started 2022, just went straight up again. So last 3 months, nice gains. Even the last month, pretty choppy. And then for the analysis here, we can see the highest rating was Momentum, 8.52. Overall rating of a 3 out of a 5. Income, I don't know why they rated that a 5. I just don't see it. Quality, again, it's hard to judge quality. You would only know if a real company, what they're good at, unless you're an actual customer. And if not, you just have to look at their website and, dive in deep and see really what they're about. If they are a really good company, and, just to see if they have any value. And location somewhat matters, but again, just the business model itself and how they provide services. So looking at the earnings estimates, it looks like they are adjusting those higher. As far as the chart, it looks good. But again, I don't know why they're raising these estimates. And I'm going to see if they give me margins. Nothing. It's not giving me anything. Debt is at 86%. Oh, there's a mosquito in here. So close to 87% actually. Net income is at over 200 million. That's slightly better. That's the best in 5 years, but slightly better from 2 years ago, which was second best. And moving on to their balance sheet, which is at 87%. So the actual numbers for that is 5.8 billion in assets, 13.8 in debt. Cash flow, let's see if it's positive. It looks negative. Yeah, It's going to be negative cash flow. So with that said, it's not a good sign. Again, they can use net income, but that shouldn't be the solution for it. That can be one of the best solutions, although there's not many. But again, I'm going to see what the company does, and that's what pretty much on their decision. So it looks like they do give dividend raises again. Raises for this company not that good from 2020. Highlighting that they actually made 5 payments in 2020, if I'm reading that right. So 18 cents. Yep, 5 payments. But even then, they remained flat in 2021, still giving the same 18 cents in 2021. So there was no dividend raise in 2021. And for 2022, they finally gave a raise. They gave 2 raises, 19 cents. And then for October, that was a raise of a penny. And then they gave 20 cents. So not much of a raise. As you can see, a bunch of splits here. So this company is definitely good for day trading. This is definitely not good for long term, since it devalues your shares. So for this stock, even though, the 5-year and the 1-year, again, like I said, they have a nice chart for the short term, but for the long term, I'm going to say no. So if this makes any sense, yes for the short term and no for the long term. So there you go. Those are my answers. Next stock up is FRC, First Republic Bank of San Francisco. Right away, I don't like the chart for the 1-year, even for the 5-year. Typical charting and typical bear market of what we're in. New lower lows. It's even close to its 2020 highs, which is expected from some companies since they've been struggling. And again, this is not a company that's pretty small. It's a mid-sized company at 22 billion. So this company has definitely taken a hit. But as for their earnings, they're fairly priced. So what I'm saying is this is a fair price to get. It's not overvalued or undervalued. That's like on target. Now, 52-week high and low. Look at that difference of close to $100. Their earnings are definitely high at 8.39. Dividend is at 1. Dividend yield is not even 1%. So they have really good numbers, and that payout of $1 and compared to their earnings is really, really good. For the long term, if this wasn't a bank, I would like the numbers and even not only the popularity, but the actual activity in this stock. It's very, very active from the numbers that I'm seeing. And then also, let me see here. With so I like the fundamentals. I don't like the technicals. For growth, it had the highest number. Overall rating, it was given a 2 out of a 5. Momentum doesn't have momentum. I disagree with that. I could be wrong just because I see this number for today. But even for the average volume, it's giving me over 1 million trades per day. So that is definitely very active. So I would disagree with this number for the momentum. And I got to give more credit onto the overall rating just because it has more momentum. For the income, I'm not crazy about it. I don't consider this an income stock. As for quality and growth, that's what I'm going to look at. And value, we already decided. So for growth, we want to see the numbers for this company. So definitely, this is what I'm talking about. You see how that was adjusted for Q4? Lower numbers. I'm expecting slightly lower numbers than this come next year in 2023. I can't determine the exact number, but I just know it should be lower just because the way the economy is going. Now, I want to see something real quick. Are they a consumer lender? No, they're not. I'm just shocked by the way they have really, really good numbers from what I'm seeing. Now, I want to dig a little deeper and see more overall numbers. So, return on equity, earnings per share. Margins is not showing me. The debt is at 91%. And typical. Now, net income 1.48. The highest it's been for the last 5 years. Now, balance sheet is at 181 in assets, 165 billion in debt. Cash flow, are they positive or negative? Want to look at that. So definitely positive, and they can definitely afford the dividend. So we're looking at about 6 billion in cash flow. That's definitely a lot on the sideline. I don't know if those are shares put aside, that's on reserve or whatever, or in bonds. I'm sure they have all that going on. But they can definitely afford some nice dividend increases. And I don't mean a penny. So we're going to look at the dividend history. Have here ever since 2020. 19 cents, 20 cents. So 20 cents all the way to 22, 22 cents. And in 2022, they did an increase from 22 cents to 27 cents. That is definitely a nice increase. I would say if they continue a nice dividend increase, even while they are going through rough times, if they can stay positive in their cash flow and continue doing what they're doing, or if they happen to, uh, you know, make even a small asset purchase or whatever, I think this stock could do some real damage on the uptrend. And not only that, just because of the volume alone, I think that's what made this stock what it is. I don't really see it doing too bad just because of the popularity. And yeah, it's taken a big hit, but it's always companies like this that you want to look at, because if they can maintain their earnings, then this company can, again, like I said, do some real damage in the long term. So they're doing pretty good, to be honest. So for this stock, I'm going to say yes. And we're going to move on to the last stock that we have, and that is BOH, Bank of Hawaii. So let me see if I covered everything. So 1, 2, 3. So yep, Bank of Hawaii is the last one. Now, Bank of Hawaii, so I've heard of this stock before. It's been mentioned. Their dividend payment is pretty good. Earnings are pretty good, actually. I like that the stock is more than like, $30. Because for the most part, I've been seeing companies, not even, banking companies under $1 billion. So this is a small cap company, but I guess people seem to like it. Fairly priced, and shares are actually pretty active. 52-week high and low. Nice range of activity. Free float. And then we have there, those are the shares that are left over. Those are the total shares that were available for the beginning of the year. And we'll see if that gets adjusted next year. Now, the difference for that would be, I'd say about 800,000 shares. So it's not like super crazy, but enough to say it's really active. And now for the charting, I'm not crazy about the chart. It looks like it went on a slight discount, which is good. So it looks like it has been holding up. It hasn't broken out to new highs in the last 5 years. So this stock doesn't seem like it's going to break out anytime soon. It just seems really steady. So I don't see no capital growth, just solid income pretty much. And this is definitely a good income stock compared to other stocks. Again, I only seen companies pay slightly over $1 and stuff, but again, they have good earnings. Looks like strong earnings. Dividend yield is okay, nothing crazy, but pretty decent. And then again, it's fairly valued. So, pretty good stock. And now for the quants, we have here Quality Company. Momentum, I'd say it's slightly better than that. And the income, I'd say it's way better than a 4.5 for a bank stock. Growth, I don't see any growth. Again, those past 5 years were flat. Unless for some reason they magically or decide to see another company as a threat and say, hey, we got to invest and then buy out another bank. That's typically what they do in order to grow. So I don't see any declines for estimates for this year, even towards the end of the year, especially here, the last two. Starting for 2023, again, I expect a lot of companies to lower their earnings expectations. And that has to be very, very it has to be very, very like how can I say? I'm trying to think of the word. It has to be known to companies that they're gonna expect everything to be lower. We're in a tighter spot. Yes, the markets have been on a run for like the past month, but it's just a fake rally. It's a trap. A lot of people, it's hard to explain, but just because the holidays are around and it's just seasonality. It's just part of the cycle. That makes sense. It's a time to be happy. Everybody wants to pretend like, let's just set it and forget it, put it on autopilot. I'm going to enjoy my vacation for the holidays and whatever and, take a break and then come back to it next year. When in reality, they're damaging the stock market even more because pumping money costs money. So the longer this takes, the more pressure you're putting on the market, to be honest, and it has to go down because again, you just can't print money out of thin air. So with the debt for this stock, it's at 92, but we want to see if the return on equity is positive or negative. So it looks like they know what they're doing for asset appreciation. So they know how to maintain their money and their equity. So basically, they're just maintaining everything. They don't see anything at a loss. Their net income has increased for 2021. For 2021, their debt is at 92, going actually really 93%. And then they're really, really in a tight spot. Now, for cash flow, we have 377 million. So I'm gonna add that. So they're at 2.6. So they're wow. They're in a tight spot for cash flow. Very, very tight spot for cash flow. Yeah, they're in a very tight spot for cash flow. Again, really good company. They can afford a slight raise, but what I want to say is, uh, for some way, somehow, they need to just maintain that cash flow position. In 2020, they did not make dividend cuts. So from 67 cents, that continued into 2021, even for the first two payments in 2021, which is good. And then in 2021, they went from 67 cents to 70 cents, and then they continued paying the 70 cents all the way into 2022. Now, for this company, again, I would say yes for a watch list, but I wouldn't buy a lot of shares. Definitely not in a top 10 in a portfolio. This will be like below top 10. So this would be a nice, yeah, this would be a nice pick and selection for an income stock. Again, it's hard to say what's a good price for this stock. I mean, it's fairly valued. You can try to get away with a little bit lower, maybe in the high 70s, but who knows? Time will tell. So, again, this stock seems pretty active, and again, this doesn't seem like it's gonna pop real soon. Good for income, but just not enough capital appreciation. So just expect steady income, and be very nimble to exit this position, because anything can just change at a snap. So that's all. I know this video is much longer than I wanted it to be. Um, I'm a bit over than my half an hour. I know not a lot of people watch these videos, the long versions, but again, stay tuned for the shorter version, and I will get that soon out today. So thank you guys for watching, and I'll see you guys in the next one.